Hi, this is another episode of mine where I'm trying to illustrate the key understanding of risk tolerance in an investment. So, firstly, the risk tolerance is the amount of loss that an investor is willing to lose when making a decent investment decision. And there's need for you to checkmate your risk tolerance before you go into any investment. It could be in the stock market, it could be a business, it could be a trade business, it could be an operational business or whatever type of business you want to get into. Provided there's an element or there's a portion of returns that you get when you involve yourself in the investment or in the business or any operations or whatsoever. So I've got series of factors that are involved in trying to check your risk tolerance. And these are the key factors that I use to check my risk tolerance before I venture into an investment. The first one is the financial situation. Okay. So the financial situation, it's basically the condition of a person to be able to generate revenue or to not be able to generate revenue or returns or profits or whatever. So you have categories of salary earners, you have categories of students, you have categories of unemployed people who might be interested in investments, but due to the financial situation, they cannot do that. So, what are the level of income of these people, the salary earners, the students, the unemployed people all together? So, for example, you can have a salary earner, earning um, a maximum amount of 200,000 naira monthly, okay? And you have a student that earns, let's say, 50,000 per month, and you have an unemployed person, unemployed person that earns, or let me say, at the end of the month, he gets like 10,000 naira because he's unemployed, so there's no way to make money from whatever. So these categories of people might want to invest, and with the level of this amount, there's a different amount 200,000, 50,000, and 10,000. Can they invest now? That's the question. Because if you want to invest, what type of investment do you need to go into? Can they take the risk now? That's the question. If you want to take the risk, what amount of risks are you willing to offer? Are you willing to decide on? Are you willing to get when you venture into any business? From the level of income, if the level of income is constant, okay, and you are certain that the job, or you're certain that the student or the unemployed person gets the amount of money every month. So, do you want to make the returns now? Do you want to take the risk now? The risk tolerance in any investment has to be critically measured by knowing the financial situation. So, your financial situation is a key point that needs to be studied, that needs to be assessed before you go into an investment. I tell people that before you go into an investment, you must have at least 6 months averagely. You must have at least 6 months expenses covered. You must have an amount of at least 6 months of your expenses covered. So from January till June, you must have that available amount of money to cover your expenses, whatever amount you are spending in a month. So before you venture into any business, before you venture into any investment, okay. So what are the reasons why you need to invest? I'm coming to that. So the financial situation is a key factor or indicator that helps to assess an investor's tolerance when they want to take the risk. Okay, you just don't say you have 50,000 or 100,000 or 200,000 or 1 million or 20 million before you invest. So you must have covered some expenses. You must have covered some, like averagely, you must have covered some level of spendings that you take or that you cover every month, because this would determine the generation of your revenue or generation of your income when you go into the investment. So that it won't be like a financial obligation or a bottleneck in the long run when you venture into an investment that's like 5 years period or 10 years period. Okay. So it's very, very important. My second point is my second point is the type of investors. The type of investors. As a risk, if you want to tolerate risks, you must know what exactly you are before you tolerate risks. You need to know yourself before you tolerate risks. You need to know what you're capable of before you tolerate risks. You just don't go into the market and see because, okay, Mr. A or Mr. B is making returns and you want to go into that because of the level of returns they've made. But how about yourself? Can you take that risk that they are taking? Can you take the risk that Mr. A is taking? That's a question. So we have the conservative investor. We have the conservative. The conservative investor is an investor that can forego potential investment, but at least the capital is safeguarded. Like the capital is safe. Okay. They want to keep their capital. They want to keep the capital and forego returns. Okay. If the capital is 500,000 and the potential return is 100,000, it makes sense to them more to have this capital to be safe than having everything to be saved like all together, because they don't want anything to affect this 500,000. They can forego the 100,000, but they can't forego the 500,000. That's a conservative investor. We also have moderate conservative. A moderate conservative investor is an investor who wants to preserve the capital, okay, but they're willing to take a little amount of risk. That's a moderate amount of risk. So they also want to keep the capital, okay, and take, let me say, 0.03% risk. Okay. They also want to keep the capital, but also they want to take little amount of risks. So if they are putting 500,000 in this, 500,000 naira, the amount of risks they want to take is if you multiply 0.03 by 500,000, you should have 15,000, I think. 15,000. So altogether, okay, what they want to take is the risks they want to make in this amount is, okay. That means if they want to lose any amount of money, right? If they want to lose any amount of money, it's just going to be like is going to be 15,000. Okay, so this results to 485. They can't lose more than 15%. That's the moderate there. They can't lose more than 15%. So another one is moderate. Yeah. A moderate investor is an investor that is willing to balance the risks and the return together. Okay. They want to balance the risks, balance the risk and return together. So these kind of people, they are like, is it they are 50-50? Okay, I want to lose 10% risk and I want to make 10% return. That's basically a moderate investor, what they are. So if they are investing 500,000, the amount of risks they want to lose is 0.10%. The amount of return they want to lose is 0.10%. So that it's like a 50-50 chance. Okay, it's a 50-50 chance. So another one is moderately aggressive. Moderately aggressive. A moderately aggressive investor has this priority of a long-term investment as the key thing you need to know with a long-term investment, long-term return, and also willing to take more risk. So you should know this is a long-term investor that's moderately aggressive, long-term investor, and long-term start from is more than 5 years. Long-term investor willing to take long-term risk. Okay. And they're also in for long-term returns. Okay. Long-term investments, long-term risks, and long-term return. While the last one is aggressive. This is where I belong. Aggressive. An aggressive investor. An aggressive investor, as part of the fundamentals of risk tolerance, has this potential, right, to maximize their investment by taking huge amount of risks. Okay, their main goal is to maximize. Their main goal is to maximize returns. Okay, by taking a lot of risk. Okay, maximize return, taking huge risk in the long run. In the long run, that's in a long time, like more than 5 years. So how do I maximize my return? I told you this is where I belong. So if I go into the bond market and I'm very certain of a return of 120,000 naira per year, okay, at the end of maturity, if my capital is, this is the return, if my capital is 500,000, I'm writing too fast. If my capital is 500,000, okay, I'm left with what? I'm left with 620,000. This is my cumulative now. This is my cumulative returns, excluding all the deductions, right? So with the 620,000, I want to maximize my return now. With the 620,000, what I would do is I'll bring this capital, the 500,000 capital. and I'm going to the commercial paper. I'll take it for a commercial paper. A CP, there's a commercial paper. That gives me the return of 0.23%. You get my point? So if I'm starting off with 0.23% in an investment of 500,000, which gives me 115, I think, 115,000, 115,000 altogether. So I can be boastful of a total amount of 615 after 6 months. I can be boastful amount of 615 after 6 months. So this means that my first return in bonds gives me 120,000. My second return in CP gives me 115. Okay, 115. So I'm making 235,000 with the same capital. I made 235,000 with same capital within a year. So if I want to like go forward, I might just pull out, where is it? I might just pull out this 500,000 from the commercial papers and take it to another investment. So I can have 2 or 3 fixed return or fixed income investments where I want to put this money, and in the next 2 3 years, I'm certain of more than 500,000 that I started with. So this is where I belong. Aggressive investor wants to like maximize their return by taking huge risks. Okay, so you can use this amount of money, this 225,000, into something else. Like you can take it into ETFs, you can take it into BTC, you can take it into treasury bills or whatever, provided that you are ready to go for a long-term investment. So these are how money is made in the market. Okay, with an investor being aggressive. So having said that, another category of risk tolerance fundamentals is the classes. Okay, is the asset class choice. The asset class choice. Okay, you don't want to lose too much money. Okay, and you are perplexed, you are confused, and you want to know what are the risks involved in different securities that are available in the market. That's what you ask an investor. I don't want to lose too much money. Okay, I have 500,000 as my capital. I have 500,000 as my capital. I don't want to lose too much money. What is the risk involved in bond? Okay. What is the risk involved in commercial paper? Okay. What is the risk involved in shares? Okay. What is the risk involved in Bitcoin? Okay. What is the risk involved in ETFs? This is what I'm going to do for an investor. I'll tell you, okay, the first one, the risk involved in bonds is 0%. And your return can go from, this is a risk, this is your return. The risks involved in bond is 0%, and the return can go from 10 to 20%. The risk involved in commercial paper is less than 1%, and the return can go from 15 to 20. 15 to 25%. The risks involved in shares is unstable. Let me just put it that way. It's unstable. And the returns can go from 2% to 30%. Depends on what's happening in the market. The risks involved in BTC is 30%, and your return can go to 50%. The risks involved in ETFs is from 10 to 20% as well. Your return can go from also 10% to 20%. So when you get this as the asset classes choice, so as an investor who wants to invest, you have the option to invest in bonds, you have the option to invest in capital market papers, you have the option to invest in shares, you have the option to invest in BTC, you have the option to invest in ETFs. So now it's this where you take your choice, right? Usually tell yourself like, okay, I want to take commercial paper and bonds together, or you want to take shares and commercial paper together, or you want to take BTC and ETF together, or you want to take all of them together. Depends on the assets, and this depends on asset choice of the investor, and it also goes to you being maybe a conservative investor, aggressive investor, or you are moderately conservative or moderately aggressive. So the other part of this is the purpose of investment. Okay, there's need to determine the purpose of investment. There's need to determine the purpose of investment, which is the fourth point now. The purpose of investments. Why are you investing? Why do you want to take risk? Ask yourself that question. Why do you want to take risk? Why do you want to make return? What is the reason why you want to put your money into this? Why do you want to do this? Ask yourself that question. Just ask yourself that question. Why? When you know the reason why, then you can go on with whatever investment you want to go into. So the purpose of investment is very, very important, because without having the sole reason why you want to invest, you might be playing around the bush and you won't know that you're just wasting your time. So one of the main reasons why you need to invest is that you want to grow your capital for a business. Okay? One of the reasons is to grow capital. To grow capital for a business. You want to grow capital for a business, right? That's the reason why you want to invest. You have a business plan. You are trying to launch in the next 30 years. No, 30 years too much. In the next 15 years. So, and the capital you have right now is 1 million. And you want to go into a business in the next 15 years. So what type of investment will you put your money into to help you to grow that money for the next 15 years? Can you grow times 10 of that money, or times 20 of that money, or times 15 of that money in the next 15 years? Yes, you can. If you put it in a smart investment choices, you definitely can, because your money should be able to have the potential to build that wealth for the next 15 years. Okay, because inflation kicks in, along the line when you put your money in any business. But when a return is fixed, like the previous points I gave above, when a return is fixed, or return is fixed, yeah, you might end up like saving your money, like safeguarding your money as a conservative investor for the period of 15 years over the time. So that's one of the key reasons why you need to put your money into investment that tends to like grow your money. So another reason is you're planning for retirement. planning for retirement. So you're 20 years old now and you're working already and you earn 350,000 now per month. You can't be using everything to eat. You can't be using everything for your transport. You can't be using everything to buy clothes, to buy food, to eat out and everything. You must definitely have this rule of saving an amount for investment. You must definitely have this rule of saving your amount for retirement. Although your company can be saving some amount for your pension for you. So when you are 60 to 65 years old, they pay you your pension. You can imagine having a pension of 20 to 30 million at the end of your service year. But what if you minimize your spending or you control your spending and you're able to save 100,000 from your 350 every month, okay, for the next 10 months, then you're able to get a million. So you're able to get a million. You can have those choices of putting your money in commercial paper or putting your money in bonds or you put your money in ETFs. So when you do this all together, you can save your money, and I can guarantee you, like in the next 10 years or in the next 15 years, you can save up to 40 to 45 million. You can save up to 40 or 45 million. You can grow this money from 1 million to 40 or 45 million, even that, which will even be more than what you have as your pension period at the end of 65 years. This all comes from investment choices. This all comes from the diversification of your portfolio. Okay. So one of the other reasons why people save money is people want to invest is that they want to they prefer investments other than savings. I'm going to explain this in one of my videos coming soon. So it's ready though. So I'm going to explain the reason why investment is better than savings. Let me just give you a brief. So investment. If I save in the bank, Bash have a saving account in a bank, right? And the banks gives me 9% for every 12 months. Okay. And Bash has an inflow amount of 100,000. Okay. This means that the multiplication of 100,000 by 9% is 0.09. That's per annum times 100,000 is 900 naira. So at the end of the year, at 31st December 2024, I'll be having 100,900 as my total amount of savings with the interest from the bank, the 9% per annum in the interest is in the bank. Bank doesn't give double-digit interest. I don't know for now, but what I've known, like bank doesn't give double interest. So this is a poor investment decision, right? This is a poor investment choice because I myself, I know the power of compounding and I know the return that I can get from other markets than this savings account market. Okay. I want to combine my investment because I can't just limit myself into this one offer of having 9% per annum with an inflow of 100,000 per annum. So in just 2 years, I'm going to have Um, in those 2 years, I'm going to have like 1,800. You can imagine. So I can't risk that. So I'll prefer to put my money in a fixed. If it's a fixed account I want, or it's a fixed investment I want, I can choose bonds. Okay, I can. If I also want to like be involved with some level of volatility, I can choose shares. Okay, if I want to have more fixed, I can choose commercial paper. Okay, if I want to have if I also want to have another classes of assets in my investment, to have like a free financial freedom, I might also choose um I might also choose treasury bills. You can play around with all this. So when you know that your risks and your return is better than what you are putting in the bank, is way better than what you are putting in the bank. Okay. If I have a risk of 0% in bonds, I have a risk of 10 to 15% in shares, I have a risk of 0% in commercial paper, I have a risk of 0% in treasury bills, and I have a return of 20% in bonds. I have a return of 25% at the end of the year in shares. I have a returns of 25% in commercial paper, and I have a returns of 20% in treasury bills. So you can imagine like how I'm able to come up with a different investment choices that can actually give me a better return with a fair risk. I can have 90% return here, and I can have, let's say, 10% risk here, which complement it to be 100. So I can't go to the bank and say, okay, I want to open an account and you give me 9% or 10%, where I can go to someone else to get 25% or 20%. I can even split the money together. I can say 100,000. Let me put 50. Okay. Since I'm starting of 20% here, and I'm starting of another 25% here. Okay. So at the end of the month, if I'm able to make 20% from 50,000, I can tell myself like, okay, there's a 10,000 gain, yeah. And if I'm able to make 25% from the other 50,000, I can tell myself like, okay, I'm able to make 12,500, yeah, at the end of the year, right? So when I put this together, I'm able to make 22,500 with my capital of 100,000. I can tell myself that I'm able to make 122,500 just for two investments, where the bank is giving me 9% per annum. That's 900 naira. So which one will you go for? Are you going for 100 and 900, 100,900 naira, or you go for the 122,500? This is what exists. This is what is happening currently. I put my money in accounts where I get higher percent because I want higher risk. So I'll put my money in accounts where you get 9%. You get a point. So a good investor will never or will not go for the 9%. They might tend to be like, okay, it's a bank, so they prefer their money to be more safe or whatever. But in the financial market is also regulated. They're also coordinated by SEC, which is the Securities Exchange Commission. So they have a level of authority that controls them. Okay, they can't mess around with your money. Okay, so that's it. The last point is the time horizon. 1 naira of today is different from 1 naira of tomorrow. Okay, today is the 1st June 2024. It cannot be the same with 1st June 2025. There'll definitely be difference. Why? Because there'll be inflation, there'll be government policy that's going to affect the 1 naira. There'll also be changes in regulations, some regulation authorities like that. So there could be also some events, other events that could affect the country or the company that you're investing in. So the time horizon is definitely going to matter, because when you're starting an investment and you want to invest for 5 years, and I'm starting an investment and I want to invest for 15 or for 10 years, okay, irrespective of whatever choices you make, okay, there's still like a potential that either of us can have some financial setbacks, okay, and in order to compensate that, we might need to diversify our portfolio along this same 5 to 10 years, because you can't just hold you can't hold a security or an asset for 5 years without making some changes. That's what I said in my previous video. Okay. So you need to like be able to save your investments from falling. Okay. So you can have real estate, you can have crypto investments, you can have bonds investments, you can have ETFs, you can have other things, okay, in your investment. So the choice must be made right in order for you to have a combined passion for your financial growth, okay? So alternatively, if a person is investing in a stock market for a period of 5 years, the volatility is high. I've said it before. If you're invested in the shares, stocks, yeah, the volatility is very high. If I'm investing in the bond, commercial paper, the volatility is very low. Okay. Although a shareholder have access for, firstly, he has access for one, the returns per share. Okay. And also have dividend per share. So if I'm a shareholder of Tesla, if I'm holding a share of Tesla, if I have 2,000 shares of Tesla at 2,000 shares of Tesla at $120 per share, okay, I'll get the return, and I also get dividend every year. Okay, that's just a good side of shares. But the investment or the other ones are like fixed. It's just one off. So the return is stated, like you can't get more than 10% on this. You can't get more than 20% on this. So in the long run, depending on your time horizon of your investment, shares could perform better than commercial paper, whereby commercial paper can perform better than shares. And that's the reason why there's the key benefit of investments and like putting your money in a wide range of asset classes is diversification. So this is a key way to minimize your risks. Okay, if one investment underperforms, the other one can complement that to overperform. So you can compensate your returns one way or the other, which is very, very essential for your financial safety. Okay, thank you so much. I would like you to turn up your notifications for my updates, and don't forget to share. I remind myself to be Bashir Salako. Thank you.